computer. There it is. All right, perfect. All right, so last time we stopped right here at principal economic theories. So in general, on the exam, they will ask you on these different types of theories. These are the main ones you gotta know. It's Keynesian theory, where the government is expected to intervene in the economy as a major force in creating prosperity by engaging in activities that affect aggregate demand. So like doing like fiscal policy and monetary policy too, like that kind of stuff. Like controlling the taxes and that stuff. So does this very make sense? Keynesian theory? Yes? No?
Yes.
All right, cool. And then right here we have monetarist theory. And this one right here, FRB. So whenever you see monetary theory, you want to think about FRB because they're the ones that control the monetary policy, which pretty much controls the money supply, right? Where they can sell securities to the banks, either make them buy it or sell them, right? Which would in turn affect the interest rates. So they believe that the amount of money in the system has a major influence on economic performance. The reserve requirement, discount rate, and open market operations are the tools used for them to regulate the economy. Everybody good here?
Yes.
And then we have supply side economic theory. And this holds that government should allow market forces to determine prices of all goods. So like market forces would be something like Amazon, Walmart, then those big companies, right? So pretty much all this states here is that these big companies should be the ones in charge of determining the price of goods and their services because they're the experts in their industry, right? Which is supply chain, right? So that's pretty much all that means is that those big players like Walmart, Amazon, they should be in control of the prices of all their goods and services and to have less government spending as well as taxes. All right. Any questions there? All right. All right. So now we have right here international economic factors. And this right here, it's pretty much talking about the balance of payments and the balance of trade. So when we look at it, right here, we already know from like history and whatnot that whatever happens outside of the US can have a direct effect to us, right? So far, does it make sense?
Yes.
And it's about the balance of payments. It's pretty much the flow of money between the US and other countries. And the balance of payments can be a surplus or a deficit. And a deficit can occur when the interest rates in another country are high because money flows to where it earns the highest return. So, what do you guys think this means right here? Deficit may occur when interest rates in another country are high because money flows to where it earns the highest returns. Why do you think the US is going to have a deficit if another country has a high rate of return? Like, let's say they're offering 10% for a bond.
Is it because the dollar value is less?
Is exactly. And then you as an investor, you're going to go after the one that's going to pay you more, right? And if the US is only offering you about a 5%, you're going to go with a 10%, right? So that's exactly why it's going to be a deficit. Now, on the other hand, it could be a surplus. Let's say the US offers a 10% bond and other countries offer 5%. In that case, it'll be a surplus, right? All right, cool. And the largest component of the balance of trade will be the export and import of goods and services. Everybody good on that so far? Just think about trade. You're buying and selling goods and services, all the imports and exports. All right, and then gross domestic product and gross national product. I'm sure this stuff, right? These terms right here, you probably remember them from high school, right?
Right.
No? Not at all?
Yes.
Yes, perfect. All right, so gross domestic product. Look at the word domestic. So that should be pretty much everything in the US, right? A nation's annual economic outputs, all the goods and services produced within the nation. It includes personal consumption, government spending, private investment, foreign investment, and net exports. So that's pretty much everything that we produce here in the US. And gross national product is pretty much ownership based. Let's say if you have a company outside of the US, that would be considered gross national product. And then exchange rates, it's pretty much exchanging one currency for another one, like exchange from the yen to the US dollar. Make sense so far? And like here it talks about it, the dollar is weak, foreign currency buys more US goods, so exports increase. All that means is that let's say you're in China, right? And the value of your currency is higher compared to the US, you're more than likely going to buy more goods and services from the US, and they're going to export those goods and services, let's say to China, right? Because it's going to be at a lower price, technically. Does that kind of make sense?
Yeah.
All right, so this talks about offerings. Now, when it comes to offerings, there's mainly two types of offerings. There's a primary market and a secondary market. Now, what do you guys think the primary offering is?
The one they do first.
Huh? Yeah, so
The first one.
so that'll be like initial public offering, where the company issues that stock, and any money they raise from that goes to that company. Like it can go to GameStop, and that money goes to them. Make sense a little bit?
Yeah.
Now we also have, so that's a primary offering. So you have proceeds paid to issuer. Okay, what else? And just keep in mind when it comes to like public offerings, primary market, that's pretty much regulated by Securities Act of 1933. Do you guys remember what the Security Act of 1933 is?
The Paper Act.
Paper Act, exactly. It's like prospectus and that kind of stuff. Make sure we have full disclosures for our whatever we're selling, right? And then why do you think this act right here started out? Why do you think we have it now? What major event happened in the 1920s? What happened in the 1920s? Take a wild guess.
The Great Depression.
The Great Depression. There was a lot of companies that were pretty much doing like Ponzi schemes and like literally rigging the books. And a lot of people lost money.
What is a Ponzi scheme? Sorry, I know kind of off topic, but I hear that a lot. I don't know what that is.
So Ponzi scheme, it's pretty much where you're offering. Ponzi scheme pretty much involved, let's say that you have a company, right? And you're pretty much recruiting people, right? And then eventually each person pays $100, right? Now,
Mhm.
for every person that team recruits, they get X dollars, but they offer no products.
Oh.
That's pretty much what Ponzi scheme is. They offer no products, and they keep on recruiting and recruiting. And from that point on, the person at the top gets like a little bit. He gets more money, pretty much.
Yeah, because everyone's under them.
Yeah, so like if they ever tell you about anything like Ponzi scheme in general, these are not Ponzi schemes, obviously, because this is legit. What else? You might even have like someone on Instagram tell you like, "Oh, is this a Ponzi scheme?" And when
Yeah,
it's,
they have, and I'm like, what even is that?
it's whenever you don't offer any goods and services. We offer goods and services.
Yeah, like getting paid for recruiting. All right, that makes sense.
Um, so that's that. Public securities offering versus private security offerings. Okay, what else? All right, so when it comes to when it's public, obviously it's gonna be more regulated, right? So it's gonna be controlled by Security Act of 1933, which is also known as the Paper Act. All right. So when they do that, they can always advertise it to the public. A good example of this would probably be like Webull, Robinhood, which are big companies that offer stocks, bonds, ETFs, right? And they're always advertising on TikTok, Instagram, right? Now, when it comes to private security offerings, they're usually offering that to like credit investors. So that means that they're actually earning a lot more money compared to the regular average Joe, right? Who might be making about 50K a year, right? Now, make sure you remember the definition of an accredited investor. Make sure you guys remember that, okay? And they have to meet a certain net worth and income criteria. So if I remember correctly, they have to at least have over 200K in annual income. And if they're married, over 300K in income. And with a net worth over, I believe, $1 million, not including their primary residence. Does that make sense?
Yes.
All right, cool. All right, let's see. Generally exempt from registration requirements. So since they're private sector, they're most of the time they're going to be exempt from the Security Act of 1933 because it's known as an exempt offering. But just because they're exempt does not mean they can break the rules, right?
I'm sorry, can you repeat that again?
So just because they're exempt, that does not mean they can break the rules. Like let's say they're making like false claims, that kind of stuff. That's still a no-go. Just keep that in mind. And then initial public offering, it's literally in the definition. It's gonna be the first time an issuer is gonna distribute securities like stocks, bonds, and that kind of stuff to the public. Any go on that? Anybody have any questions on the definition of an IPO? Like what is it used for? Anything like that?
Um,
Yeah, what is it used for?
It's pretty much used to build capital. So let's say you have a stock for your new business that you want to open up, right? And let's say your stock was SCD, I don't know. So now that stock you offer to the public anytime someone buys that stock, it gives you working capital. Because every time that someone buys your stock, that money goes to your company. Make sense so far?
Yes.
So that's pretty much what an IPO does. It helps you raise capital. So that money you can use it for any project for your business. Did that answer your question or did I confuse you?
No, that makes sense.
Make sense?
I have another question. So you said they're exempt from the Act of 1933. What else would exempt something from the Act of 1933? Or is there like a lot of things that could be exempted?
There's a few stuff to be exempted, but for right now for the reading, just keep in mind that if it's private, they're exempt. because it's not going out to the public. If it was going to the public, they're required to follow the Security Act of 1933.
Okay.
Does that make sense?
Yes.
Yes. All right. What else?
Are there any limits to how much the Securities Act of 1933 covers, or did we already cover that?
Yeah, there's a lot of limits to it, to be honest. And honestly, I don't remember the top of my head, but I'm sure somewhere in the SIE book. But they're not really
Yeah.
going to question you too much about that. They're going to pretty much ask you like, what's the Security Act of 1933? And they ask you anything about private and public, just know what it is. What else? There's also follow-up offerings, which is pretty much any additional money that's raised. And then follow-on offerings are a popular method for companies to raise additional equity capital in the capital markets through a stock issue. And this talks more about the IPO rules and regulations. And why we have it is designed to protect the integrity of the public offering process and public investors. And the rule ensures that members make a bona fide public offering of securities at the public offering price. And the members do not withhold securities in a public offering for their own benefit or use such securities to reward persons who are in a position to direct future business to the business, right? So now for that one right there, why do you think that if we're issuing right now an IPO, right, that we cannot hold back some of those IPOs? Why do you guys think we cannot hold it back? What do you guys think?
Can you like elaborate a little more on holding it back? Like,
Let's say you have over 100,000 shares, right? That you're getting out to the public, but you're holding back, let's say, $10,000 units for your own benefit.
So you're asking like, why would somebody do that?
Exactly.
I mean, because they don't all need to be utilized at once.
Yep. So that's part of it. And then the second part of it is, like I say, if you having a whole bunch of people buying your shares and you're holding back like 10,000 shares of it, that means that the value of your shares, those 10,000 units, are going to be rising in price because it's all based
Oh,
off supply and demand.
right.
So that means that whoever has 10,000 shares is going to have an upper advantage compared to all the other people. Does that make sense?
Yeah.
And then we have industry insiders such as members and their associate persons do not take advantage of the insider status to gain access to new issues for their own benefit at the expense of the public customers. So this pretty much talks about insider trading. Anybody that has like information that's not available to the public, they cannot use that information to buy stocks or sell it for their own benefit. Does that make sense?
Yes.
And essentially, the rules apply to IPOs of common stock. And then the rule actually it prohibits member firms from selling a new issue to any account where restricted persons are beneficial owners. So if they're restricted, it's more strict. And before selling an IPO to any account, a representative are required to obtain a written representation from the account owner that the account is eligible to be purchase a new common stock issue at the public offering price. Everybody good here so far? Just keep in mind that restricted persons, most of the time they're going to be denied from buying IPOs. So restricted persons that are not allowed to purchase shares at the public offering price are defined as member firms, employees of member firms, finders and fiduciaries acting on behalf of the managing underwriter, including attorneys, accountants, financial consultants, and so on. Portfolio managers, including any person who has the authority to buy or sell securities at a bank, savings, insurance company. Any person owning 10% or more of a member firm. Any immediate family member of any person in the items 2 to 5 listed here. And like this right here, you have to know it. Who's considered immediate family members, okay? That's gonna be parents, in-laws, spouses, siblings, children, and other individuals whom the person provides material support. Does that make sense a little bit?
Yes.
Yes?
Yeah.
And now here we have secondary offerings. Secondary offering, it's going to be paid to a non-issuer. So one in which one or more stockholders in the corporation are selling all or a major portion of their holdings to the public. The proceeds of the sale are paid to the stockholder rather than the corporation. So if, let's say you have 100 shares of Tesla, right? And then you want to sell it to your friend. So you can technically sell it for your friend, but the money that you made goes directly to your pocket. That's called a secondary market. Does that make sense?
Yeah.
Yeah, makes sense. Perfect. And then why they want to sell their shares is because they're probably determining that it's beneficial for them to sell their shares right now, as opposed to holding it. And here talks about the primary offering and secondary offerings. So let me ask you guys a direct question. What we do here with mutual funds, is it a primary market or is it a secondary offering?
Secondary.
No, primary. Remember, for what we do, it's going to be considered a primary market. Because end of the day, when it comes to selling their shares for our clients, they cash out directly. They don't have to go out to secondary market and sell this stuff on their own.
Right. Okay.
All right. So now there's different underwriting commitments. So now there's best efforts and firms be acting as an agent. So best efforts underwriting calls for the underwriters to buy securities from the issuer, acting simply as an agent, not as the principal. Underwriters are not committed to purchase the shares themselves or are not at risk. Deals are closed by collecting client funds into an escrow account, so no underwriter capital is at risk in these types of offering. Now, why do you think we're going to put an escrow for the money? What do you guys think? Why do you think we have to put the money in escrow for any money that we raise? Take a wild guess. What do you guys think? It has to go to escrow.
I don't remember what an escrow account is.
Pretty much, someone's in charge of that account, and that money goes in there, and they can't touch that money. So with this right here, it protects the investors. Let's say it wasn't escrow, right? back in the day, whoever was the best effort underwriter, and they realized, oh, I didn't make enough. I'm just going to take the money and run.
That
That,
makes sense.
that's what they would do back in the day. Now that's why we have they have to go in escrow to prevent anybody stealing that money. All right, underwriter is acting as an agent contingent to the underwriter's ability to sell shares in either a public offering or a private placement. The underwriter is not at risk for the shares, but the issuer is. If all the shares cannot be sold, the issuer will not raise the needed capital. So just keep in mind when you're studying this term right here, there's going to be, when you're acting as an agent and then principal, there is a difference. So in this case right here, they're acting as an agent because they actually bought the securities, right? And there's two types of best effort underwriting. There's going to be all or none. So now by looking at the definition, what do you guys think it means? Remember, it involves selling securities, right? So you have to either sell all of them or none, right?
Yeah.
In a all or none underwriting, the issuing corporation has determined that it wants an agreement outlining that the underwriter must either sell all its shares or cancel the underwriting. And here's once again, any funds collected from investors during the offering period must be held in escrow pending final disposition of the underwriting. And then mini max right here, it's pretty simple, right? There's going to be a minimum that you have to reach, and there's a max as well. So it's going to set a floor at a minimum the least amount of issuer needs to raise to move forward with the underwriting. And it's going to have a maximum how much the issuer is actually willing to sell. Any questions on mini max? Any questions? Any questions? Everybody good on the term for mini max?
Yeah.
All right, cool. Now here we have a firm commitment underwriting. Now this right here, the firm is acting as principal. So this right here is a type of underwriting contract. Under its terms, the underwriter's contract with the issuer to buy securities. The underwriter buys shares from the issuer and resells the securities to the public at a higher price. At the higher price of the public offering and earns his price differential spread for his efforts. Here, the underwriters are acting as principals rather than agents. They are committing to purchase any unsold shares for the syndicate account. And this type of underwriting is the underwriters who are at risk for any shares that cannot sell to the public, not the issuer. If shares cannot be sold, the underwriter must place securities into his inventory and run the risk of losing money. Should the position fall in value, the issuer knows that ultimately all the securities will be sold and all the capital needed will be raised. The firm must never guarantee a customer that it will agree to repurchase the shares of the public offering price if the deal subsequently trades lower. So firm commitment, all it means is that someone's going to buy the shares, right? And they're going to sell them, and they're going to sell them above the public price, and that spread, that difference, that's going to be their commission. And no matter what, whoever did this deal right here, they cannot sell back the shares to that company. So no matter what, they're at risk of maybe either losing money or gaining money, right? This right, does it make sense? for firm commitment? Does it make sense? Everybody good? All right. Now we have here the registration securities and the Securities Act, Truth in Securities Act, and Prospectus Act. So just keep in mind that Security Act of 1933, it can refer as the Paper Act, the New Issue Act, Truth in Securities Act, and the Prospectus Act. They use it interchangeably. All right, purpose to ensure that the investing public is fully informed about a security and its issuing company when security is first sold to the primary market. Pretty straightforward, right? And it's designed to protect investors who buy new issues. So it's going to require registration. So it's going to have to require them to provide full and fair disclosures about the offering. And it's going to have available all material facts that are necessary for someone to buy something. And then regulating the underwriting and distribution of primary and secondary issues. And then providing criminal penalties for fraud in the issuance of new securities. So anytime before it goes to the public, they have to register their stocks, right? Or their bonds. And this right here is the type of information that might be in the registration statement. So you have to actually memorize this too. They're going to ask you like, oh, what information is required on the registration statement, which is not required. So make sure you guys memorize this right here. Everybody go on that? All right, cool. Now, does everybody know what a cooling off period is?
Yes.
Yep. So the cooling off period, all it means is that we just submit our registration for our security, right? Our prospectus, right? And now we're waiting for the SEC or FINRA or whoever, right, to review our documents, right? So now that cooling off period roughly lasts about 20 days. Now, during those 20 days, we are not allowed to sell any securities because our registration has not been approved, right? And let's say that you submit it, right? And 10 days later, the SEC says that you need additional information. Will the clock restart or will it resume at 10 days?
We'll resume after the 10 days.
Yep, perfect. And would it be weekday? Would it be business days or calendar days?
Calendar days.
Calendar.
So what's the difference between a business day versus calendar days?
Business is Monday through Friday, and then calendar is just like every day of the week.
Perfect, because they might trick you guys on that question right there. All right. Now, Tombstone advertisement, it's pretty simple. We're gonna put an advertisement before our registration is available. So that'll be like during that 20-day mark period, okay? But during that period, we can pretty much provide like a summary of what we're offering, but it's not gonna have any pricing, and we cannot take any orders. Any questions here on Tombstone advertisements?
So it's kind of like setting it up, right, for the next period.
Exactly. You're pretty much putting advertising before it's approved, and it's gonna have the most bare minimum. People are gonna say, "Oh, we're interested." So when you have the full prospectus registration, that's when you can sell them that the official document, and you can take official orders.
So like, what if it doesn't, or would it be only if it's getting approved? Like, what if it doesn't get approved?
If it doesn't get approved, you can still technically do a Tombstone advertisement, but you can't take any orders until that registration is approved. Make sense?
Yes.
Like you can't sound like sales literature. That's one thing you can't do. So they can be run to announce a new issue during the cooling off period. They are not required and do not need to be filed with the SEC. And this right here is the limited information that they can put on it. Name of the issuer, type of security being offered, number of shares to be sold, a public offering price or range, and then names of the underwriting members. And it has to have this information on it. This announcement is neither an offer to sell nor solicitation of an offer for any of the securities. This offer is made only by prospectus. So why do you think we have to put this on the tombstone advertisement?
So that it's clear what it is.
Exactly. So it's gonna be like in red paint, pretty much. I believe it's called in the book a red herring, right?
Yes.
So that's pretty much what you got to put in the front of your tombstone advertisement, saying this word right here. Now, shelf offering registration, it's pretty straightforward, right? So it's going to allow you to register additional shares of what you're offering and place them in the shelf for you to sell them later on. So they're going to register new securities without actually selling any of the shares until later, or some of the shares initially, and waiting to sell the remaining portions of the shares. This right here, does it make sense for shelf offering?
Yeah.
Yep. How about you, Robert? You're good there?
Yes.
All right, cool. And then once it's filed for shelf offering, it lasts 2 years and allows the issuers to sell portions of registered shelf offering over a 3-year period without having to re-register the security. So that's going to be the general rules for a shelf offering. So make sure you know these rules here: 2 years and then 3-year period. Okay. All right. So here we talk more about the state registration, the blue skies. So before we're talking about the federal securities, right? And now there's blue skies, which is towards the states. Now, the Uniform Security Act, you're going to be asked a few questions about it. And your next exam, I don't remember if it's your 6 or 6-3, it's going to have the entire book is literally going to be about the Uniform Security Act. So now what the USA Act pretty much is, it provides a legal framework for the state registration of securities. It may be adopted by individual states and adapted to their own needs. And the reason why it's uniform is that every state can pretty much copy and paste it and they modify it to their needs. Does that make sense so far? And here we have state registration requirements apply to broker dealers, investment advisors. So when you guys are licensed, you guys are going to be considered like broker dealer agents, pretty much an agent. And if you guys decide to get your Series 65, you'll be considered an investment advisor rep. And state security administrators have the power to revoke any of these registrations if a violation of the state laws has occurred. Okay. So make sure you guys know this right here, the fines at the state level. There's only 3 types. There's coordination. This is where the issuer files with the state at the same time it files with the SEC. Now, once the registration is effective with the federal level, it becomes effective on the state and federal level. Does this make sense? And here we have qualification. If it cannot be registered by coordination or filing, then it'll be registered as qualification. This right is like the last resort. And then notice filing. So notice filing pretty much means that before you sell security in that state, you have to register. Like it could be like federally covered, but you still have to put your registration for that state because that state wants money, right? So they're going to collect a filing fee. Any questions here? Any questions? And then here we have the offering documents and delivery requirements. So it's designed to provide full disclosures for investors. Right here we have the prospectus. So primary prospectus or red herring cannot be used as a prospecting tool. So now why do you think we cannot use it as a prospecting tool? What do you think?
Because it needs to be approved.
Exactly. It hasn't got approved yet. Yeah, so it hasn't got approved yet, so that's why we can't use it yet for that. All right, so that's that. All right. And it must be available to any customer who expresses interest in security during the cooling off period. Okay. And an investor's indication of interest is not a commitment for them to actually buy the security. And obviously they can't take any orders until the effective date. Now, what's the effective date? What is it? The effective date. What do you think it is?
The day it's been approved and like appointed.
Exactly, the date the prospectus was approved. All right. All right. Free writing prospectus. Any communication that does not meet the standards of a statutory prospectus. And then final prospectus. When the registration becomes effective, the issuer amends the preliminary prospectus and adds information including the final offering price for the final prospectus. A copy of the final prospectus must be precede or accompany all sales confirmations. And this part is going to require to have the description of the offering price, the selling discounts, the offering date, and the history of the business. Risks of the purchaser, the description of the management, any SEC disclaimers. So make sure you guys memorize this here too. And these right here are general rules for the final prospectus. Now, for initial public offerings, 90 days of security is to be quoted on over-the-counter pink sheets. And then this stuff right here, you're going to have to memorize it. The 90 days, 25 days, the 40 days. Just make sure you guys memorize it, write it down, whatever you guys will do to memorize it, because it will come up on the exam. Any questions so far on that? Any questions?
No, sir.
All right, cool. All right, now there's a few securities are actually exempt. And when we actually talk about exempt, they don't have to register because they're out they're with they don't have to register with the Security Act 1933. So that'll be like U.S. government securities, municipal bonds, commercial paper, and bank acceptance that have maturities less than 270 days, insurance policies, and fixed annuity contracts. Now, for this, why do you think a fixed annuity is it's exempt? Why do you think a fixed annuity it's exempt? Think about it. Are they being offered a guarantee or not a guarantee?
Guarantee.
They're being offered a guarantee, right? So that's why it's going to be exempt. The customer doesn't really have a risk, right? And that's why it's going to be exempt, because it's offering them a guarantee. National and state bank, okay? Building and loan securities. And then charitable, religious, and education nonprofit association issues. And then interest in railroad equipment certificates, and then banks. That's pretty much the end of this chapter. Any questions? Do you guys have any questions on the reading, anything like that? No? Do you guys want to do a quick quiz? All right, right there. Let's go to steps of licensing. Securities, SIE. Show this again. All right, cool. Agree. So no, this is gonna be part 2. All right. Of course. All right, dashboard. Quiz. Let's do unit 2. And let's do this one. Economic indicators, the business cycle, Federal Reserve, fiscal policy and trade. And let's take off 7. All right, cool. And we'll keep that one there. All right, cool. Let's see. Show score as you go. Launch quiz. The cost of doing business is closely linked to the cost of money, which is known as, what do you think it is?
Demand.
Demand? You sure? Are you sure?
B,
Huh?
interest.
Interest? There it is, interest. Remember, supply and demand. Supply, demand. That's the same thing, right?
But you need to have interest.
Mm-hmm. The cost of doing business is closely linked to the cost of money. The cost of money is called interest. During periods of economic decline and contraction, one would expect, so now right here, the economy right now is declining, it's contracting, right? inventories to decrease, consumer demand to increase, production to rise. Will production rise? What do you think it is? You think it's A? Huh?
I think it's A. Ah, shoot.
Kind of close. Gross domestic product to decrease. Rising employment due to an increase in demand for goods and services will be associated with periods of, would it be stagnation?
No.
How about stagflation?
Mm,
Or is it deflation? Or is it inflation? What do you think it is? So right, remember with stagnation, remember stag, it's kind of like stagnant, right? And same thing with stagnant, is a little stagnant right now with the employment. So it might be between B and D.
and D, yes, that's I'm
D.
between those two.
You want to go with D? Inflation? Because a little bit of inflation could have rising employment. There it is, inflation. Which of the following can encourage economic growth because gradually increasing prices tend to stimulate business investment? Deflation, high inflation, stagnation, mild inflation. Which do you think it is? It could be between B and D again. What do you think it is?
D.
D.
There it is, D. Mild inflation encourages economic growth because gradually increasing prices stimulates business investment. High inflation reduces a dollar buying power, which hurts the economy. Now, this one here talks about fiscal policy. So now if they wanted to slow down the economy, what would they do? Raise taxes and cut government spending for for programs in development. Cut taxes and increase government spending for programs in development. Cut taxes and government spending for programs in development, or raise taxes and government spending for programs in development. What do you think it is? So they want to contract it, they're probably going to raise taxes, right? So out of the back right now, you probably have between A and D, right? So
A.
what do you think it is? A or D?
A.
A?
I don't know.
You see right now what I'm doing? Is I'm like pretty much saying like I know for a fact it cannot be B and C, right? Because if you cut taxes, that's gonna loosen fiscal policy, right?
Right.
So it's gonna encompass increase in taxes, leaving consumers with less money to spend, and then cutting government spending for programs and development. So if they cut those programs, they're going to create less jobs. Make sense?
Yeah.
All right, US consumers are increasing their imports of foreign made goods. On this data alone, one might expect gross domestic product to, what do you think it is? Decrease, remain the same, and then increase. So what is gross domestic product?
Uh,
All things US.
Yep, all things US, right? So if we're buying more stuff outside the country, would that decrease it or increase it?
decrease.
Decrease?
I think it's increase.
Increase? So we're stuck between A or D, right?
Yeah.
We'll put right here decrease and see what it is. Decrease. See, it's likely that production of US goods will fall off, leading to a decrease in the gross domestic product. Which of the following sets of FINRA rules focus on how member violations will be handled? Would it be the Uniform Practice Code? No? The conduct rules? Or is it a court arbitration or the code procedures? Which one do you think it is? Remember, look at the question again, okay? Which of the following FINRA rules focus on how member violations will be handled? So when they have like some kind of procedure, maybe, right? Now, code of arbitration, that's when you're going to court, right? Pretty much for whatever violation you did. So it might be between A, B, or D. We know for a fact that's not C, right? So it might be A, right?
I say A.
Yep, it's A. A surplus in the balance of payments is best described by more money flowing into the United States and out, more money flowing out of the United States and then into the US, the United States importing more than its exports, other countries exporting more to the US. Which one do you guys think it is to have a surplus? We're going to have excess of something coming to the US, right? So you think it might be A?
So that's when it exports more than it imports, right?
Yep. Remember, balance of payments, it's about trade, right? Right?
Yes.
So now it could be A, right? But now I would say maybe it could be C, it could be A or C. Because we know for a fact balance of payments, it's about trades, right? So it should have the word trades or exports inside it, right? So now, what do you guys think it is? A or C?
C.
C? It was A.
Oh.
So this is the basic definition of a surplus and the balance of payments. Generally, this is a result of the United States increasing exports and decreasing imports. Recent reports indicate that the gross domestic product has been declining steadily over the past 2 quarters. Now, this one right here really comes down to knowing the definition. Now, I don't remember the right terms, but we know for a fact it's declining, right? So that could be either a recession or a depression. Now, depending on how long it is, it makes a big difference. So 2 quarters would pretty much mean like 6 months, right? Would that be considered a recession or a depression?
Recession.
Recession? There it is. A recession is defined as 6 consecutive months, 2 quarters, or more of economic declines. By contrast, a depression is 6 consecutive quarters of economic decline. So 6 quarters will be pretty much 6 times 4, so like 24 months, right? All right, so now this talks about the Uniform Practice Code. It establishes uniform trade practices pertaining to all the following except, would it have this, the settlement at X date? Yes. How about communicating with the public? Right, it would have it, right? And then don't know procedures. Does it look right? And then good delivery procedures. So right now we're in between C and D, right? So which one do you think it is? For the accept?
Don't know procedures.
It's actually B, communicating with the public. Well, right. It's regarding like when they talk with other member firms. There are 2 distinctive types of policies implemented to shape and mold the US economy. They are what? This is pretty obvious, right? Which one do you think it is? Take a wild guess. It's in the book. What does the FRB control? What does the Federal Reserve Board control?
Is it monetary and fiscal?
Exactly. So it should be A. Remember, fiscal policy is controlled by Congress and the president, right? That's like doing the tax laws and that kind of stuff. And then monetary policy is controlling the money supply with FRB. Now, for this right here, for these 2 right here, which one would take longer to get approved? Fiscal or monetary policy?
Fiscal.
Fiscal, right? Why is that?
Because monetary isn't it just like one?
No, well, yeah, it's true, but fiscal, remember, it has to get approved by the president and Congress. It's very hard to get Congress to agree on something, right? That's why it takes longer. Let me see, that's Alba calling me. I'm on a Zoom training. All right, for the SIE class. All right, so that's that. Financial Industry Regulator Authority, FINRA, regulates all matters related to investment banking, including Will they regulate fixed annuities? Do they care about commodity markets? Commodities, they don't care about it, right?
Right.
And then trading in the over-the-counter market and then trading the future markets. They don't care about D. They don't care about B. So it might be C, right? There it is, C. Economists call mild short-term contractions. 12, this one really comes down to the definition, right? There's 12s, there's declines, and there's recession and depressions. So which one do you think it is? If you had to guess. You guys think it's A?
Would it be recessions again, or?
It could be recessions. There it is, recessions. All right. When engaging in open market operations, taking actions to either expand or contract money supply, the FRB will buy or sell. This one, once again, it comes down to the definition, right? So what are they going to sell? You think it's B?
Is it A or B? Between A and B, or?
B.
Mhm.
Which of the following cannot enforce their own rules? This one really, once again, it comes to the definition, right? So out of these four right here, which one is it? This right here, do you guys remember what MSRB stands for? No? Well, it should be A. There it is. MSRB relies on FINRA and SEC to enforce its rules in broker-dealers. So this right here, this board right here, it relies on FINRA and other SRO bodies to enforce the rules. Make sense? All right, if the US dollar is relatively strong against the Japanese yen, so the US dollar is stronger compared to the Japanese yen, what do you think we're going to do? Are we going to buy more goods from the US, or are we going to buy more goods in Japan?
Buy more
Japan.
Japan, right? So we got to look for a question that talks about that, right? The US dollar will buy more goods produced in Japan, while the Japanese yen buys fewer goods produced in the United States. Does that make sense here? Does A make sense?
Yes.
Mm-hmm.
It might be that one, right? Let's keep on reading the next questions. The US dollar will buy fewer goods produced in Japan. Does that make sense?
Right.
No, right?
No.
The US dollar will buy fewer goods produced in Japan. Does it make sense? No, right? And then the US dollar would buy more goods produced in Japan, and the Japanese yen will also buy more goods and produced in the United States. It doesn't make sense, right?
No.
So it should be A. Everybody got this question?
Yes, sir.
All the following are leading indicators except, and once again, this is where it really comes down to the definition. What is a leading indicator? So this one right here, if you don't know it, you have to kind of guess. You think it's gonna be personal income? This is the only one that I see that's out of the blues, right? What do you guys think it is?
Right.
The money supply, new orders, and stock price are all leading indicators. These increase in advance to an increase in economic activity. Personal income, however, is a coincident indicator moving along with economic activity. So you see how, like, when I was looking at the question, I was looking for the one that was out of the blue. That didn't really make sense,
Yes.
even though I didn't know what the question was asking, right? According to the U.S. Commerce Department, the economy is in depression when a decline in real output of goods and services lasts. Now, remember, what's the difference between a recession and depression? How many quarters does it have?
Recession is 2 quarters.
All right, recession is 2 quarters, right? How about depression?
6.
6. It's going to have 6 quarters, right? So it should be C, right?
Right.
See, it is. Which of the following is the largest self-regulatory organization of the SRO? Now, off the back, is the SEC a SRO? No, right?
No.
So we're going to take off C, right? Now, out of this right here, the largest one should be FINRA, right? There it is, FINRA. All the following are coinciding indicators except now this, once again, you kind of have to like look for the oddball out. Because do you guys remember what the definition of a coinciding indicator is or no? It could be between it might be A or it could be D. What do you guys think it is? What do you think it is? I was gonna put A. Changes in durable good inventory, whether an increase or a decrease, is a leading economic indicator. Trade sales, retail employment, and personal income are all coinciding indicators. We didn't do too bad. We got 80%. That's good. All right, y'all. So just finish up reading chapter 2 if you haven't done it yet. I mean, part 2, whatever it is called. Do you guys have any questions on the reading, anything like that? No?
Not yet. Not yet.
Everybody good?
Yes, thank you.
All right, no problem.
And then for next class, so like I'm still on unit 2.
Yeah.
Right. Where should we like be at for the next class?
By unit 2, you mean that you're referring to the first edition, Robert?
Second.
Second edition? So that means wait, so by unit 2, you mean you're still on the first part or second part?
Second.
So you're on the second part now, right?
Mhm.
Oh, you're good now.
Okay.
You're on the capital markets, right?
Yeah, that was getting to that right now, like that
Alright, cool.
part.
So just try to finish that, and then if next week we finish already session 2, then we'll go to session 3. Make sense?
You got it.
All right. Well, I'll let you guys go, and you guys have a good day today. Okay.
All right, then, Oscar, appreciate you.
Great day.
Oh, bye.